But we just want to make the insurance industry really simple and understand what you have your hands on. So the total U.S. life insurance new premiums last year alone was 16.2 billion. So that's probably not 100%. They didn't pay out 16.2 billion in commission, but I'll bet it was 10 billion. And the way that breaks down, term insurance is 3 billion or 19% of the market. It was up only 1% last year. But if you look at IUL, it's 3.8 billion, 24% of the market, and it had a record high and it grew between 4 to 10%. Okay, so we're in the right place at the right time. And then whole life, of course, is the biggest, and it's 5.8 billion, and it was down 4%, but it's 36%. So agencies that are just focused on term insurance, writing mortgage protection, or they're focused on whole life only. They want to do the final expense policies. I like where we are because if we're talking to somebody about mortgage protection, we can pivot to an IUL. If we're talking somebody that's got a lot of debt, we can go ahead and do the IUL and then fill in their debt with a term policy. So we have a lot of flexibility. And then, of course, the whole life market's important to at least know, just because you're going to have people that may not be able to qualify for an IUL, and you got to know how to pivot to another product because, why the person got a hold of you because they wanted life insurance. And so we want to make sure that we can deliver on that. So pretty simple. When you look at just what I call the business, and I'm kind of focused on the business here, the business characteristics, just so you guys know, again, we got a lot of new people, a lot of experienced people, but term insurance is cost focused. So the language for that is, hey, Preston, how much can I get? How much will $100,000 cost me? Right? That's how term insurance is done. Less than 2% of the policies pay a death benefit. I can tell you stories where it would have changed people's life if they had term insurance, and I can tell you stories where it did change people's life because they did have term insurance. But it's like playing blackjack in Las Vegas. The odds are always stacked against you that it's going to pay a claim. About 10% of those policies charge back. Okay. What we like to focus on is IULs because it's a long-term product. In other words, I like what Juan says. It's like planting a little seed, and then your monthly payment is watering that seed. And so nobody ever asks, hey, how much can I borrow in the second year? Because, an apple tree, for example, doesn't give off any fruit in the second year. In 5 years, you've got a nice little tree. In 10 years, it's getting bigger. In 20 years, it starts feeding you. And in 30 years, it's an orchard. But if you start picking the fruit off that tree too early, you're going to stunt the growth. And that's how he positions it. Our persistency rate in April was almost 98%. So less than 2% of the policies fall off the books because of this long-term focus, which I love. And it's contribution focus. Nobody ever asks you how much would $100,000 cost me. I'm saying that kind of tongue in cheek because people will. So when you look at the cost, term is the cheapest, IUL's in the middle, and then whole life is the most expensive. So whole life insurance is usually about 30% more than an IUL. So a lot of times when you're working on a client and they have 25,000 in whole life, but they really wanted 100, you can show them an IUL and you can show them the cost savings with it. The reason it's more expensive, it's the only one of the three that's guaranteed to cover you all the way up to 120 years old. So you're paying for that. Okay. So also it's important to point out as we kind of do this basic training here that there's two kinds of whole life insurance. And Alicia, you were asking about this, I think. There's day one coverage, which means when you write the policy, if they pass away the next day, it pays. And then there's what we call the TV insurance. TV insurance is all guaranteed issue. You got to pay into it for 2 years. After 2 years, if you pass away, you get all your money back. Within 2 years, uh, I'm sorry, within 2 years, if you pass away, you get all your money back plus 10%. Okay, it's like a savings account that you pay into. After 2 years, you get the full face amount. Now, a lot of people you talk to on the phone, if they have a whole life insurance policy, they don't really know. Hey, Leanne, can you let those people in, please? They don't really know that they have a policy from Mutual Omaha that they bought online, or from AARP, or from Lumico, or who can forget Colonial Penn. Your premiums never go up. Those are all guaranteed issue. In other words, you're going to pay in those things. And I've run into people, and we covered this a couple weeks ago. Their parents had a guaranteed issue. The kids didn't know it, and they are appalled at the fact that it's not going to pay the full face amount. So what we do is we do day one coverage. Okay. So hopefully this is making sense. This is pretty basic stuff. But the last point I want to make here, and Francis, I amended this, so this wasn't in my notes that I sent you. So, but I hope I'm not stepping on what you're going to talk about. But there, Danny Sellis had been confused on this issue for good reason. There's actually three types of insurance. The first kind is fully underwritten. This is Northwestern Mutual. These are the biggest of the biggest companies, and they don't write a policy without sending a nurse out to the house to do a full medical exam, blood and urine tests. And I got on Chat GPT. It said it's about 45% of the market. Okay. Many people that you're going to work with, they get denied and they don't think they can get life insurance. If you've ever worked with a client that says, "Oh, don't worry about it, Mark Tucky, I can't get insured." And you ask, "Why do you say that?" They said, "Well, because my wife got a underwriter in here 20 years ago and I got denied." And I said, "I can insure you because it's a different kind of insurance. It's fully underwritten. It's the cheapest insurance you can get. It's very inexpensive because they only take the best of the best of the best." Okay. What we do is two types of insurance: simplified issue. There's no medical exam or fluid testing. This would be like Americo. They run you through the MIB and you get approved, thumbs up or thumbs down. And this is about 18% of the sales. And then National Life Group, F&G, this would be considered accelerated underwriting, where they don't do an exam like National Life Group. Under 50 years old, they'll go up to, I think, 3 million with no blood or urine. And that's about 36%. So we're doing, what is 36 and 18? It's 14, 4, about, it's over half the market, 50 some percent. Okay. So I just want to share, that's kind of the macro level of how life insurance works and what the industry looks like. It's very basic for some of you guys that are the pros that have been in this thing for a while, but for other people, I know when I went into a home one time and I was talking to this guy and I had my Americo term, and he showed me his pricing on his Northwestern Mutual. I could feel my face turning red because I was just embarrassed. I didn't know the difference between blood and urine with Northwestern Mutual and Americo. And he's like, "Dude, you are so expensive." But we're not expensive to that guy that had blood and urine 20 years ago and couldn't get insurance. And now we come in and write him an NLG policy and he is thrilled. Okay. So anyways, so if you have questions on that, you can put them in the chat. And Francis, where's Francis? Okay. And
I'm
let's
here.
okay, perfect. So, and you can share your screen if you need to, right?
All right.
Oh, Captain America. Yeah, right. Yeah, that was, we were having fun with that. And we can, yeah, MJ, you're right. We can do fully underwritten if we need to for those really big policies. We have several companies that will do that, and the pricing is amazing.
All right. So what I want to share with everybody is really, when and how and why, or I guess and Neal touched on it a little bit, but it's two things. One is the sort of the mentality, or the um, what's the word I'm looking for? I'm digging for a word and I can't think of it, but it's how you sell it. Okay, so I have this little comparison chart up here, and some of you guys, you know, already know this, and this may be just a review. For some people, it's gonna help you understand some things. And so earlier, we've a couple of weeks ago, I think we had talked about pivoting. If somebody can't qualify for an IUL, and we can pivot. Um, so when you look at an IUL, our sales process is totally different. We're talking about usually some type of tax-free retirement, being your own bank, generational wealth. Not once do we mention life insurance. Life insurance is a byproduct for that. Okay, for that index universal life. Whole life, we don't sell a whole lot of whole life that's similar to index universal life, because we don't have a lot of carriers that do. Now, Transamerica's one, National Life Group has a whole life product, but again, it has a tendency to cost more than the IUL. Um, so the cash doesn't grow as much as the IUL. So we focus on the IUL. That's mainly what our focus is. Um, and in annuities, but right now we're just really talking life insurance. But there's some reasons, people will obviously purchase a final expense product. Now, final expense, for those of you that might not know, that it is whole life. It's a type of whole life, and the type of whole life is restricted, and that's what allows people to get qualified. So they won't let anybody just get covered. If you're 22 years old, you cannot get a final expense policy. You normally have to be over 40 or 45, or in some cases 50. It depends on the carrier. So we have those, different carriers, and I probably need to update this slide, but can y'all see the carrier slide that I have up? Is that a yes or a no? Um,
Yes.
okay, good. So, some of these, Americo, Transamerica, AIG, which is Corebridge now. So I need to update this so I can get the newer people, their newer carriers, or their names on there. Um, they have these final expense products. Okay. Excuse me. And they all have different ages and things like that. So what I always recommend is, when you get contracted with the carrier, make sure you're going to that website. If I don't know how some people exist in this world, but if you go, you should have a bookmark for every single carrier that you have. And if you're going to America, you need to know how to log in, how to do a quote, where the underwriting guidelines going to be. Same thing for Mutual of Omaha. If you're going to, you should know how to do quotes like that, so you can help your customer. If you don't have all that stuff bookmarked, and if you haven't gone on those sites and learned what products that they have, okay, and how to get around that site, then you're doing yourself a disservice, as well as your client. And so each carrier, if it's National Life Group, they all have underwriting guides. And that underwriting guide is going to tell you, if it's, especially when it comes to the final expense product, it's going to tell you what the age limit is. There's a stopping limit. Some of them go to 80, some go to 85. Aetna goes to 89. Some have a build chart. So depending on the weight, they might not qualify for America, I might have to go to, you know, Mutual of Omaha, for example. And let's see, I normally had mine open. I don't have it open right now. I religiously use National Life Group's underwriting guide, and I have it normally open so that I can, you know, quickly go to page 23 is the build chart. And I'll know right away whether this person's going to qualify or do I need to pivot. So, you know, so the understanding products, one is what they do and why. Okay, so a final expense is a whole life product, and as you can see here, duration, it's a lifetime product. So your two lifetime products are whole life, which final expense is a whole life, and index universal life. Those are your two permanent or lifetime products. Um, you know, premiums, normally it's more expensive. Final expense is going to be way more expensive than just regular whole life. Um, Regular whole life is going to be higher than index universal life. Normally with a fixed premium, index universal life is flexible. Every year, every other month, you could change your payment if you wanted to after the first year. You know, they would go crazy, but you could actually do it. You know, cash value, just yes, final expense technically, because it is a whole life and it's permanent, it does grow some cash. If y'all didn't know that. Um, but that's not what that policy is designed for. So it's very little. Most of the money. So think about an IUL. An IUL, 90% goes to cash and the premium, 10% goes to pay for life insurance, roughly. For a final expense, it's like 90% goes to pay for life insurance, maybe 10% might go to cash for that permanent final expense product. So very little cash growth. And then term, for example, as we know, is a temporary product. It only lasts from, you know, 10 years, 5 years, 15 years, 20 years, 25, 30 years. I don't know of any of them that go beyond 30 years. Every now and then I'll run into somebody, I think it's Primerica, and I don't know how they do it, but they go to like 90 or 95. Now I don't know if it starts going up at age 70 or some of the things I need to find out. But um, but anyways, it is a temporary product. It's the like Neal said, it's the cheapest product out there. It's the type of product that you're selling based on life insurance, not what can this do for me. Okay, it's like how much is $1 million of coverage going to cost me? You know, when we're doing an IUL, if somebody asks that question, then I know they don't understand how an IUL works. Um, so, you know, there is no investment component. Same thing with final expense. You know, whole life uses a dividend. If you know, if somebody, does anybody not understand? Has anybody come across the situation where they needed to figure out or help explain a whole life compared to an index universal life? Has anybody run into that where a client asks them that? Just unmute and say yes, or if you have. If not, then nobody's run across that. I have.
I have.
Okay. Do you know the difference? Do you understand it?
I do now.
In which what do you mean you do now?
Well, because I was selling mortgage protection, so I would be asked about IULs and other products, but I didn't understand how an IUL worked, so I couldn't explain it.
Gotcha. Okay. So yeah, so now when you get to the uses of it, okay, so the term, for example, is a great product for mortgage protection. And I wish I had a good illustration, but I really don't. Years ago, there used to be what's called a declining term. And Marico actually had one and they did away with it just 2 years ago, probably. So there is no declining term anymore, which would be ideal. Okay, because if you think about how a mortgage goes, a mortgage, the 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 uh, the mortgage is going to go down over time. Well, if your mortgage starts at 500,000, it's not going to stay 500,000 for 30 years, but yet we get a $500,000 30-year term to cover that mortgage, to in case that the breadwinner dies, it pays that mortgage off. It's as simple as that. Now, you can get real complicated, and I have, and you can actually create a decreasing term, but I'm not going to go into the woods there. So, but why would you use? So let me go to my little thing here. Let's go to let's say, where's my term? Terms up here. All right. So term can be used for income protection. And there's a rule of thumb. Okay, it's protection until your children are financially independent, or to pay off the mortgage or other liabilities. So the term is used many times. So somebody has 3 kids, both of them the parents both make the same amount of money, so you technically want to cover both parents for income protection and mortgage. It's kind of all the same thing, but some people just really want to look at income protection. Some want to just focus on their mortgage and have a little bit of extra life insurance with their job or something they feel like, and so you might just focus on that mortgage and figure out how much term you want for that. Then you can say it depends on their budget. If they have money, well, then you can go to, in a sense, like a whole life, or we would use an index universal life, and say, why pay this amount for 30 years when you could pay a little bit more, have the same coverage, and get all that money back and then some, and be able to use the money even while you're, and so that's when you pivot to an IUL for helping somebody with a mortgage, because it's permanent, and it gives them a lot more flexibility, and it gives them living benefits. Most term products do not have living benefits, and so that's why when it comes to the term, and I don't think I have that in that chart. I don't think living benefits are a part of it. No. I mean, why choose living benefits as one for the index universal life? Almost every index universal life, Mutual of Omaha, F&G, Americo. Well, I don't know about Americo. MJ had brought that up today. I know Ameritas with Ethos, National Life Group. They all have living benefits. It comes with the IUL. So most IULs do. Whole life has a limited living benefits that do come with it. Term, I know critical, maybe chronic illness would be with your whole life. A lot of final expense doesn't have any, and then most term does not have any living benefits. So your term, you can add living benefits if it's a Transamerica. National Life Group comes with it. Again, that's when you need to be a student of the business. You need to go to the carrier itself, okay? And you need to go to those product sections and learn about it. Or ask questions. Ask me, ask Neal, ask MJ, ask anybody. That's, if you don't understand something, but every one of them has products, has training, different tools, underwriting guides, you name it. Okay. But, you're going to go to the life insurance of that company and find out all the different types of products. I mean, they have whole life, they have index universal life, they have a fixed universal life, a whole life, a term life, a survivorship. They talk about living benefits, all the different riders, in which states that you can write in. So, you need to know that with all your different carriers. And we don't contract with all these carriers. I mean, there's just too many.
Hey,
but
Frank,
you're going to be yeah.
Can you show like the section of the website, somebody had asked, where do I get these brochures? And on National Life Group, where would they go to get brochures?
So, I mean, is it a brochure for you or is it a brochure for the customer?
Yeah,
If it's a
good point.
brochure for the customer, you go to marketing. If it's just understanding the product, which they have their own kind of brochure that's going to talk about, these different products or whatever, I believe it's product. But they all have it. I mean, if you go to Mutual of Omaha, for example, they're going to have a section on products. So every carrier, once you get, you know, um, once you get what you call it, your your writing number with that carrier, go in and dig into that website and wear it out, learn every aspect of it. And that way you're going to be just that much better. You're going to find things that you didn't realize. But you can go to sales and marketing, you can go to products. I mean, they have a ton, but if you just come over here to their life section, you can learn about their term, you can learn about their index universal life, their underwriting. So here's, sales tools. And it goes by state.
Yeah, they are
Well,
so anal retentive, man.
yeah. Different sales tools. But anyways, you can get in here. I downloaded I have their underwriting guide. So what I do, just kind of help everybody out. Maybe you guys are like me, maybe not. I have a folder called carriers, and in my carriers are like special things, like things that America. I have flyers, bank draft forms, HIV forms. I mean, I've got, if I go to National Life Group, I've got a folder just for their forms because I've had during underwriting, there's different forms that people have asked for. But also I have their underwriting guide. So like, if I go to Mutual of Omaha, I can go down to, and so you guys need to be, and all this came off their website. So, there's their underwriting guide.
But Francis, this is something you've put together since 2020 when you got in the business.
Right. But that's what I'm saying is you need to start. If you guys aren't doing that, because we can't cover every single thing that every carrier has. We can give you the big picture. We can give you hey, what does, the different uses of life insurance and the different types. I mean, this is it. This is what we sell right here. Index, whole life, final expense, term life, and annuities. Okay. Annuities can go down there and it can be its own. There's multiple types of annuities. So you can get into that. That's another section we can go into. But that's it. That's all we do. It's really simple because we're protecting something. If somebody dies, there's protection. If somebody gets really hurt, like living benefits, there's protection. Some products have it, some don't. So understanding that and knowing that, there's reasons for life insurance, index universal life. Most of it is for lifetime coverage and a type of investment, a growth, cash growth. Okay, that's usually what the need is of index universal life. Most people are looking at it more for a 401k alternative. And then it just so happens it has life insurance. Your whole life normally it's a permanent life, and that's what they're looking for. Final expense, it's a permanent life, but it's going to cover just a limited. Final expense is, the highest I know is Mutual of Omaha goes to 50,000. If you want over 50,000, you can't. You have to go to an IUL or something else. Final expense is not going to work for that person, but normally they have to be like 40, 45, 50 over. So again, it has its limitations. But that person could have had a stroke, heart attack, cancer, and still get qualified, where they're not going to for index universal life, or they're not going to for term, because those two have the highest or the most stringent underwriting. Okay. And that's really all I wanted to cover. I'm open for questions because I'm sure you guys might have 1,000,001 questions.
Yeah, Francis, one of the questions that came up is you mentioned living benefits. And so there's a saying with IULs that life insurance, you buy it for when you die, and an IUL, you buy it for living, for when you're living, because not only can you borrow from it, over contribute, but also there's chronic critical illness, critical injury, terminal illness riders. And these things, you don't have to die to get a payout. So, for example, National Life Group, they boast about how many, they're the number one insurer of firemen, because if a fireman goes into a fire and gets severely burned, they may never work another day in their life. It's just kind of the way it is. But they can get, if they have $1 million policy, they'll run them, their age plus this formula, and they'll front them a certain amount of money, if not all the money in the policy. And NLG, they brag on, I think they paid out 110 million
Yeah, last
accelerated
year.
living benefits last year. So they really stand, it's not just a marketing tool, they really stand behind it. So that's what, when we talk about living benefits, you'll notice, and you haven't run an illustration yet, but when you do, it shows how much you're paying per month, how much total life insurance you're getting, what the cash accumulation is at 65, 70, 85, so forth. And then at age 65, what the living benefits would pay out based on the illustration. So it's a great product. So that's what those things are all about.